Hello. Nice to meet you, and welcome today at Money 2020. It's a pleasure to have the opportunity to speak with you. First of all, how are you today in this very gray Amsterdam day?
Yeah, well, thank you for having me. It's a pleasure to be here today. Well, it's lovely to be in Amsterdam. It's pretty crowded. It's a great event. I've been there last year and 2 years ago, and there is always plenty of good face to see and great company to follow. So that's definitely a nice touch and a nice event every single year.
Yeah, this is the first time at Money
No,
2020 for you?
third time actually.
Okay,
Yeah, that's
cool.
my third time in Amsterdam. Yeah.
So, do you want to give us a little bit of background of yourself and of Breega as a fund? Of course?
Sure, of course. Thank you for that. Yeah, so Breega, we are a pan-European VC. We're managing close to 700 millions now. We have offices in London, Paris, Barcelona, Cape Town, South Africa. We have three large core verticals, which are seed investment, venture investment, covering A and B round, and Africa pre-seed opportunities. In the past 10 years, we have collected and invested in more than 100 plus companies. Most of them are actually fintech. So I'm pretty sure we will talk about that in a few moments. What is important in our DNA is that everyone in the investment team here at Breega are former investor and former entrepreneur, sorry. So everyone in the investment team used to experience the entrepreneur journey. So on my side, I kickstarted before joining the team 3 years ago. I kickstarted two ventures in the accounting space. The first one was a chartered digital accounting firm called Fred de la Conta. The second one was an ERP for accountant called Inqom. Well, long story short, we did raise 20 million euros in total. We go from 0 to 150 people in 7 years, doing accounting for roughly 10,000 SMBs. And in the end, we managed to exit those two businesses. The first one to a strategic player in the south of France called Secondaries. The second one to a Norwegian PE group called Visma. So that was quite a journey with the highs and lows of the entrepreneurship. And I guess it's really, really helpful when it comes to become an investor and supporting the founders on daily basis. The rest of my career is pretty much M&A. So I was working on small and mid-cap deal, transaction services, first in London and then back in Paris. So yeah, that's pretty much me in a few words.
Yeah, nice. First of all, we share the M&A experience so that we could talk about it.
Yeah, of course.
But I'm very interested about your experience in the bookkeeping and accounting space, because this is one of the trends that we saw recently in this industry. You know, there are a lot of companies trying to innovate there. Both fintech companies and ERP trying to do something new in that space. What do you think about the current trend in the industry?
Well, I think it's a very interesting moment. I think especially when it comes to bookkeeping, automation has been on the table for many years. It has been dropping for accountants. If you think about it, it's really low added value task. I mean, taking an invoice, trying to copy paste the numbers on your ERP for every single day. It's not the best for everyone. It's very low added value. So even on our side, when we kickstarted the Inqom venture, automation was on the table already. With the former technology, it was already up to 80% of automation. So I think with the new model, you can reach close to 100% with a very nice quality and consistency. That's what is key, because to automatize, I would say, bookkeeping for lawyers or for services companies is pretty easy. It has been on the market for years, but now you can expand that to pretty much every kind of business. So for sure, it's appealing, and it will be commoditized at some point. I mean, people will not work anymore on bookkeeping. At some point, they will have to expand to new kind of services, and that's where the real opportunity is, in my point of view. So you will see several services converge. You will have the banking services that will be more connected to the bookkeeping. And so it will be super helpful for the underwriting, for instance. And so the bookkeeping solution can move to banking as well, and lending. So I think everything will converge in a larger bucket, and it will be, especially for SMB, super powerful in the end.
And you think it's going to be a player covering the full flow hand to hand? Because we were talking yesterday with a couple of your colleagues, and they expect someone to be able to actually handle from A to Z on that flow, including the payment and including the monetary flows of that kind of transactions.
I think it depends on the segment, to be fair. I would say when it comes to SMB, for S, I'm pretty sure you can have something that is covering all the spectrum. Because in the end, I mean, bookkeeping, you have payment flow, it's needed to do the book,
Yeah.
to do the reconciliation between the invoices and the payment. So it makes ton of sense. So accounts receivable, accounts payable, bookkeeping, payment, and so banking and potentially lending. It makes ton of sense to see company potentially like Penny Lane or Conto going that way and to cover all the spectrum. When it comes to the M in the SMB, I'm not that sure because you will have, as you grow, as you become more mature, you will have more processes, more people around the table doing with those stuff. So I'm not that sure that someone will be in a position to cover all the spectrum for all the aspects of such companies, especially for the 50 FTEs companies and above.
Yeah.
But below that, I'm pretty sure someone will take over.
Okay. Now that's really interesting. And what are the main trends that you are looking at the moment? Because here today there are two main trends that are stablecoins and AI, probably that are all over the place. Let's say, but we are seeing many different kind of trends in this industry at the moment. From administration of funds to bookkeeping, of course. What are the main trends that you're seeing outside of the main,
I think stablecoin is a great opportunity when it comes to cross-border payment. We're still lacking of transparency, efficiency, especially when it comes to payment between LATAM and Africa, for instance. It's slow. You have a problem to find local liquidity and so on. And in that regard, I think stablecoin is a great opportunity. We have actually a portfolio company trying to deal with that pain. It's a company called Fipto. It's a company that we back at seed stage 2 to 3 years ago. And we can see that the value prop clicks in. The market will mature and at some point it will become like very natural to process payments through those stablecoin corridors. And regulation is helping quite a lot as well. I mean, back in the day, it was more for the lower segment, but now I think we will have in the coming years or months, so even on the short term, a regulation system that will be helpful for, I would say, the higher segment, even for enterprise to process payments in that regard. And that's, I think that's a great opportunity. When it comes to AI, well, I think we can talk about it for hours, but in my point of view, AI in the fintech space can have two great opportunities. The first one is fintech, most of the time, they are leaning on a bunch of suppliers. When it comes to payments, you need to work with KYC providers, transaction monitoring provider. Exactly. And to maintain integrations for the long term with all the complexity of all the processes, back in the days, you need engineers to do that. And a bunch of squad of engineers to do that. So the unit economics, the cost, the structure of cost of those companies, they were not super appealing for investor. With AI, you can maintain that with less people. You can create processes that will use the logic of the models to maintain that for the long term and be adaptable. And I think that's a great opportunity. For the cost of structure for companies dealing with SMB as well, I mean, onboarding can be complex. And with the new models, you can have like live onboarding. You can really talk to an agent saying, oh, should I do that? What is my opportunity to connect my account, whatever. And so back in the days, it was a human doing that. So it was in the cost. So to grow, it was super costly when you have to do like hundreds of onboarding every single week because you have to deal with a team. Nowadays, it can be managed by human and AI in the middle. And so you can grow in a much more efficient way. Same for customer success, same for whatever. The next big opportunity, in my point of view, when it comes to AI is how to query the data. Because back in the day, you have to manage SQL queries. So like it's very technical stuff to just access your data, organizing the data the way you want to just, to use your work actually. And now you can query the data with a very natural way. And you can actually play like an engineer with the data with not being super technical. So I think it's a great opportunity, especially when it comes to accountant, legal, payment monitoring or whatever. And once you can aggregate and organize the data the way you want, you can move to BI, to business intelligence, so you can monitor, predict, and whatever. And when you have that, I think you can create a lot of value.
No, it's a very interesting concept because for a long period of time, that part of data entering or data validation has been done by humans, but it's not have added value kind of feature, or kind of work.
Yeah.
So it's kind of very pointless to do that with a person that can contribute in any other way, So I find it very interesting. At the same time, what I'm struggling a lot in the market recently is to divide between companies that are actually using AI to provide value and the one that are actually using AI as a buzzword, as a way to actually get an investment maybe from an investor. So I was wondering, how do you actually divide them? So when someone actually pitch you an idea in the fintech space and they say, okay, we have this kind of platform based on AI, yada, yada, yada. How do you actually divide if they are actually using AI, really using AI, or just wanting an investment because they are, riding a trend?
That's a very good question. And actually that's a tough situation in the today market. Actually, I think our entrepreneur journey is super useful in that regard. Back in the days at Inqom, bookkeeping automation was at the core of the product. So I was working on the model that did that. It was not rocket science, to be fair. It was fairly simple. It can be much more efficient today if I adapt the model. So I would say that we patented that because back in the day, it was, I would say, fancy to patent your technology. So I'm fairly, I would say, aware of what you can do or not do with the model, what is on the shelf, what you need to fine tune and so on and so forth. So when people are trying to oversell their AI stack, it's fairly easy when you are a little bit technical to, I would say, to identify the potential, not liar, but people trying to oversell it a little bit. And most of the time, especially in fintech, you don't need crazy stuff to make very decent automation. If you take a step back, most of the time we're talking about numbers. And I would say the biggest innovation change that happened in the last 2 years were based on words, sentence, so not numbers at all. So for sure it's helpful, but the core models have been there for quite a few years for underwriting, monitoring, to do KYC scoring or whatever. It has not changed a lot in the recent years. When it comes to accessing and talking to your product in a more natural way, for sure there is opportunity today, but for the rest, I think it's pretty stable too.
It's a fair point. I mean, so a follow-up question on this one, because you said you are able to actually spot them when you talk with them. So we came from a couple of years when we find out some very strange deals in the market. Like one of the most curious one was the one from JP Morgan and Frank, the startup that actually faked all of those users. So I was wondering, are you actually doing tech due diligence right now when you actually buy or invest in a startup? So real technical due diligence or just the financial one? Because it's not always the case, so it's not always standard anymore nowadays.
Yeah, you're right. I think when it comes to financial due diligence, we are doing our work in-house and then we move to auditors, which is the market practice. When it comes to technical due diligence, I think we are not using external auditors those days, but we have a team of, I would say 60% of the team is only former engineers. So a few of them have worked on data. So when it comes to product identification or diligence or whatever, when you talk to the tech stack, I think we are pretty okay about that. I don't think we did too much mistake in that front. But I'm pretty sure that's because we are coming from the entrepreneur background. So we experience the fundraising process. It's a wicked game. It's a communication game. So at some point you're trying to overselling some stuff. And at some point when you are moving further in the process, everyone should sit down saying, okay, we are good at that, not so good at that. We don't know that. And that's fine as a founder to say that. And that's pretty much the founder we would like to back for today and for the future. So we don't like the founder that is 100% sure that he knows everything, because that's maybe he knows everything today, but it will change next week. So nothing is certain in this market. We saw that like for the past 2 years, and on the founders we are backing, I think in terms of DNA and value, it's a recurring point, and so at some point we can sit down together and identify the problem on the product. So I think it's fine.
It's a really good point. I mean, nothing is sure anymore in this market, I would say, in the last 2 or 3 years. I was wondering, probably it's one of the most common questions that you get asked to, but how do you actually choose them? So I've been talking with many VCs over the years, and everyone has his own thesis. Someone is everything about the team. Someone else was a competitive advantage. Someone else was, a precise niche or a specific vertical. So how do you actually choose the startup that you want to back in or that you want to support? Because obviously you need to support them on your investment committee internally. You need to push for the deal that you want, So how do you actually choose them, the one to bet on?
It's a mitigation of a lot of ingredients, to be fair, on my side, at least. I'm always trying to find opportunities where you have like impact at very different level. For sure, the market has to be big. It have to be impactful for the society or for the segment. It doesn't have to be a new category. I don't like to be personally as an investor, people trying to create a new category, because for sure it can be appealing, but then the PE fund that will take over, he will step back and say, what's your bucket?
Yeah.
How should I evaluate your company? Yeah. What's the market? Okay, you're trying to create a new category. That's nice, but is that a real one?
Yeah.
So I think I'm less disruptive than some of other investors in the market. I like where people are creating like positive outputs on the society. I like where there is a nice balance on tech, founders, market fits, when I can have like added value as well. Because if I'm going to be like a sleeping partner at the board level, that's not for me. I want to be hands-on. Maybe that's my personal experience as a founder. Trying to be super helpful with my portfolio company. But if I'm useless, I cannot open doors. That's not something I would like to back. And in terms of financial profile for the company, it's really important for me to identify quite early what kind of asset we can back. Is that a fast growing one? Is that a potential cash cow? Is that something so we can adapt at the board on the decision we're going to take as a board? I think it's super important. Otherwise, you're just you're betting to something that you're not in control, and so it's super complex to create a business case for the next investor to take over. And I think that's one of the big reasons the VC, the classical, the pure vanilla VC game is it challenged those days. It's because some people, they are just betting on growth. They are forgetting some very important financial ratio. And so you have a business case which is hard to create for the next investors. Most of the time, it doesn't have to be crazy or super complex. It doesn't have to be rocket science. People have to identify they can do 3 to 5x with a nice certainty, I would say. And if you have that and a decent valuation, you're gonna go to fundraise some capital. Fundraising those days is super tough. We experience some downturn, whatever you can mention that. And back to reality is really important. For sure, we have to be ambitious for our portfolio company. It's the game. It's part of the game. It's a wicked game, to be fair. But we have to, I think, consider risk these days.
It's funny because you said that today's environment is very tough, and I totally agree with you, to be honest. Also, the portfolio company that I have in my portfolio are experiencing the same. But I was recently talking with the CEO of a fintech company, is very well known in Europe, and he was telling me this environment compared to 2021 is a paradise. Raising funds today is so easy compared to what it was like 2 or 3 years ago. So I really believe that it's up to everyone's perception, and experience in this market. But it's very nice to see the different point of view in the.
But I think he's right. I mean, when you are the next potential outliers and you stick to your plan and you're executing what you say to former investor, it's we have a portfolio company named Jump, and they are exactly on their plan. That's super rare, and I'm pretty sure when they are going on the market later on this year, they will raise some capital. I'm certain about that. But it has become the market in fintech, especially, grow massively in the past 2 years. So you have excellent company, I would say decent company, good companies. I would say the best decile or quartile will raise capital. For the rest, I mean, the market has to calm down a little bit. And if you're not good enough, well, that's part of the game, and you will not raise capital anymore. Or maybe you will move away from the VC path, which is again 100% fair, and you will move to the from the 3x year over year to the 100% year over year, which is still very fast growing company, and that's enough. I mean,
that's good enough. So tell me about one of the deals that you prefer that you did during the years. So something that really stuck with you over time.
Yeah, I think we did Dalma Series B, so pet insurance company in France. That was a very nice process, especially because Alban and Raphael, they are crazy founders. They are excellent. They are super transparent and humble. And this is a very fast growing company. And they are pretty young. And I think what strike me is their agility on how to adapt in this very market. They did raise quite a bunch of capital at Series A.
Do you remember how much?
I think it was close to 20.
Oh, okay.
And so they were growing as fast as possible, not having a look on the unit economics. And at some point they were like, okay, we should settle down. We should work on our unit economic. We should protect our asset. Otherwise, it's going to be complex for the next phase. And they did that. They did that just in 9 months. And at some point, we were in the market where you have like a bunch of pet insurance company which are not big enough to raise capital again. So that's a great potential build-up opportunity for us. And once we adapt the growth strategy, they close their Series B super rapidly. So having an organic growth strategy plus some build-up opportunities, once we show that to the market, I mean, the round was closed pretty rapidly. And I think it's a very interesting one. It's not pure plain vanilla VC, I would say. It's more financial. Yeah. But we can see how to create value with those guys. And again, we have other opportunity at some point. We can move from MGA, so that's their model as a broker in insurance, to potentially full stack insurer. And so we have a lot of key driver to execute and to operate in the coming years, and that's super, super exciting, I would say.
So the proactiveness of the two founders made this. Okay, no, that's really interesting. So you said something before that stuck with me. You said the current VC model, standard VC model, is not always applicable or is not working anymore for everyone. Yeah. Do you actually think that we need a new VC model right now? Because this is a conversation that I had multiple times recently.
Yeah, I'm sure.
There are many funds that are trying to find different kind of models under the VC perspective. Some of them are focusing on the fee side, so trying to charge less money to their investors, to their LP, and everything in order to provide more value, of course, and be a reasonable investment. Some of them are more focusing on the investment targets. So which kind of niche, which kind of targets, which kind of startups, of course. So do you actually think we need a new model, and what that model could be, in your opinion?
I think the biggest problem is exits, to be honest.
So the liquidity side.
Yeah. If you take a step back, I think the median last year in exit value was 25 million euros. Okay. So most of the Series A company are having a higher valuation than that. Yeah. So to create value together, I think we have to be more grounded and say, okay, we will have some moonshot that can go to IPO, and that's super interesting. And then we need to feed the private equity funds. And private equity funds, they are writing check between 50 to 200 millions. Above that, very few transactions. We just did that with Didomi and Marlin, for instance. It was a majority transaction that was exactly in this range. It's a very good deal for everyone. It's a good deal for the founders. It's a very good deal for Breega. It's a very good deal for Marlin. We have created value, and we will continue to create value together. So I think we have to be more adaptable. We have to take liquidity when it's on the table, and when we need that. And and for the potential moonshot, for sure, we need to push them until IPO. I think the IPO market is really tough. I mean, the latest IPOs, quite a few of them in 2024, and they have experienced, I would say, complex market condition. For sure, the risk aversion in Europe is not the same as in the US. So if you don't have the right profile, it's gonna be tough for you, and you will experience some decrease in the market share. So that's for sure. You will have liquidity, but at what cost? At what cost? Because that's on the private market. I mean, the price is at one moment and you don't have to deal with the market, the public market condition every single day. So you will have to wait for the next round. So you can grow, you can adapt, you can do crazy stuff in between. When it comes to public markets, you have to be aware of what to expect, I think.
Yeah, no, I strongly agree. I was also very convinced that this year was going to be the year of the IPO and the year of liquidity. It's not the case at the moment. So we are seeing some of them. We are seeing some of them being delayed for market condition, of course. So I was so sure about it. But what I'm seeing right now is that certain companies and certain investors are finding secondaries as a solution to that problem of liquidity.
That's true.
Being, forward many opportunities since September 2024 until right now on secondaries on very, very interesting companies, very well known. And I think that could be a good solution. I think that democratizing the secondaries market, making more accessible to different kind of investors, even smaller investors, could provide the liquidity that is necessary for funds to move on and to grow further. I'm not sure if you ever considered that kind of thing.
Of course, we have very big portfolio company like Exotech. We back them at a pre-seed stage, and they are now doing 400 million in the recurring revenues. So that's giant companies. So for sure, we can consider secondary market, especially when the fund is 10 or 11 years old. We had to consider that. Most of the time, the deal with the secondary fund is we remain at the board level and we are interested to still perform very good performance at the board level. So we have carried interest. There is a SPV created for this very opportunity. So I think that's the best way. And we will experience some discounts. But I think it's needed. We need to give back money to our LPs. Otherwise, at some point, the next fund will no exist.
Exactly.
And I think when you have a close look on the fundraising for VC in the first quarter, where the numbers, they are not so good.
Yeah.
So I think it's kind of
necessary.
Yeah.
Later.
But if everyone is going for secondary today, the discount will be bigger, and that's a fair point. I mean, I think we, as investor, we have to take a step back, and I think we waited too long to do that. Everyone is going to ping them now.
Yeah. No, it's a very good point. You were mentioning closing a second fund because obviously the model is the same for everyone. You raise a first fund, you deploy it, then you start with a second, yada yada yada. But there is actually a couple of funds that are doing open funds over time, not just closing the first, but continuing over time. I think Sequoia is one of them, one of the most well-known. Have you actually considered something like that? Do you think it can work?
I don't have any personal opinion about it. I would say that evergreen fund, when you have like a very powerful customer, can be a very interesting model. Because in the end, we've seen that in the past 10 years, the market can be with a strong momentum, and then the momentum is much more on the other way. So this model can be very appealing, but you need to work with very large asset manager as LP to manage that. I think it will be super different where you are raising capital. I mean, when you can deal with pension funds, you can think in very different model because the money flow is pretty much certain for the very long term. So you can adapt and you can propose something new. I mean, the inception of Breega is in France. The pension scheme in France is well known by all the European people. It's not private, so we don't have any pension fund. So we have to go abroad to find the right LP to potentially imagine this kind of product. Let's see how it goes in the future. We are not considering that at the moment.
Okay. Pretty cool. Which are the main trends that you are looking at the moment? So we have been talking about bookkeeping, AI, stablecoins. There are any other kind of trends that you're looking at? Maybe not that famous or not that very well known in the market that you're taking a look at?
I'm not a huge fan on trends following, to be honest with you, because at some point, to make the math work, in my opinion, if your entry point price is too high, to make a decent exit, and again we move back to the previous point, it's super complex. So when everyone is talking about the odd deal, I will talk to the founder for sure. But if I don't know how to create value with him or with her, I'm not gonna move forward. I prefer to to stay grounded and to be in the money rapidly as an investor. So it really some pressure at the board. You know, when we did our Series A as an entrepreneur, we took the higher term sheet.
Okay.
So it was valuing the company 30 times the recurring revenue. So that's for the egos. That's very good for the ego. But when you put your investor cap, you know that the company has to triple down his revenue just to be back in the money.
Yeah.
So it's putting a lot of pressure on the company.
Yeah.
And it depends on the markets and the industry you're working on. But sometimes you cannot master your pipeline. I mean, when it comes to enterprise deal, I mean, with Trump in the markets and the US condition those days, I mean, the business decision, they are not as fast as before. So you can lose 6 months in a row and you are working well. That's not on you. That's just the micro environment. So yeah, I would say that super trending stuff, not so much for me. I love when there is technical opportunity. So we mentioned that some of them for querying the data, preparing the data, maintaining integration, and so on and so forth. I think maybe it's not as fancy as other stuff, but I know how to create value with those companies, and that's much more my.
Yeah, that's a very good point. Putting on your founder hat, let's say, you were mentioning, taking the higher term sheet for a little bit of ego under that point of view.
Yeah.
But now that you also have the other side of the experience, what would be a potential advice to founders out there, when coming to fundraising? So what they should take a look at and be aware of when actually fundraising?
I think it's really important to you have to be open with your investor on all the topics. Well, it's a hard exercise because when you're fundraising, you want to be seen as a very appealing asset, with a high potential asset. But at some point when the communication and the conversation is moving forward, I think you have to be honest about what you don't know, what is going to be a challenge, what will avoiding you to sleep at night, what is whatever. And if you're not in a position to that, I think the next page you're going to write with your new investor will be tough because it will be harder to take the good decision, the bad decision, because actually not everyone is on the same page. And I experienced that as an investor when you're arriving on the first board and actually the picture is not the one you expect. I mean, when you're missing the point by 10%, that's fine. But when you are missing the point by 50%, that's not a good starting point. So I would suggest to be honest, and it's tough, about what is going to be a challenge. So everyone is on the same page so you can take the right decision. When you have to do some layoff, being aware on when to execute and operate a layoff is super important. When to hire fast is super important as well. So I would say honesty, finding someone when you can talk super openly, that is aligned with you on the vision and the way to grow, knowing the market super well. Can open, or he or she can open you some doors if you don't have those recipes. Well, and if he or she is the higher bidder, that's even better. But I think people have to be aware of that's a capital business. So receiving capital is a big responsibility. So you have to create value on the top of it.
So let's not focus every time on the amount of check that you get, but also on the things that they want in return when giving capital. That's a very good point.
And because to be fair, after at Series B or Series C, it's when the company is more mature. People will evaluate you on strict financial numbers.
Yeah,
I mean the potential is there, but I mean you can sell your company on the potential, not anymore.
Yeah.
So you have to stick on the numbers.
It's not 2020 anymore.
No, and that's good actually.
Yeah.
That's good because to raise capital because there is recent AI on your deck and you don't have anything. I mean, that's cool, but I'm not sure it's going to create value.
I totally agree with you. I still remember that time when with a good PowerPoint and 50 slide you could raise 3 million from investors, and was totally crazy. I saw valuation 30 or 50 times the EBITDA in the fintech market. Makes no sense at all.
Sooner
or later it was going to end. So it's just a point. But maybe, again, talking to your founder side, if you were a founder to start something today, in one of the industry one of the flow or the trend that we've been mentioning, what you would start today?
It's a good question. I'm not sure I was a great founder from the 0 to 1. So if I'm moving back to the entrepreneur journey, I think I will buy a more mature company, to be fair. I was more enjoying my entrepreneur journey when we had a team of 50 plus people. That's for sure, because you can do some arbitrage, you're understanding the model, how can I adapt my LTV over CAC, should I grow faster, should I grow slower to improve my efficiency? So that was a part of the journey I enjoyed the most. But for the 0 to 1, I will definitely move to an industry and a business where there is high predictability in the revenue. Because trying to create something with a low predictability is super tough, because you need to iterate even faster, even more often, and you need to pivot all the time, at least in your mind, and to keep your team as one, to have them for the long term, to extract all the performance from all the team across your company. When you have the predictability, I would say good predictability in the revenue, that's the one. So I don't have any industry in mind.
Any specific one, yeah.
I think that's the beauty of SaaS. That's the beauty of today's situation. You can create an experience, an idea in a few minutes, hours / weeks. And it was not the case before. I mean, before, to have an MVP, a decent MVP, you need 6 months, 8 months, 9 months.
Yeah.
Because it was tough to develop something. Now you have so much stuff on the shelf. So to iterate it's much easier.
It's a fair point. Maybe last question on my side. We have been talking about specific trends in this industry, but as a whole market, as a fintech market, overall, what do you see in the future of this industry? What do you see happening, let's say 3 to 5 years from now, with everything that is going on, from stablecoin payments to AI to geopolitical situation? How do you see the next 5 years in fintech?
I think regulation will keep going up, the pressure on the regulation side of things. So I think KYC, KYB, transaction monitoring will be even more important. Maybe they will be embedded in the payment solutions at some point. I think the market will consolidate.
So you see a wave of aggregations in the market?
Yeah, for sure. I mean, that's and the nature of payment. Payment is an aggregation business. I mean, the value chain is super fragmented. You are leaning on tons of suppliers. So for sure, the market will consolidate, because there are great products on the market. Maybe not with I would say, good financial profile yet, but there are, I would say, good product to be integrated. Then you will have like all the AI wave for financial services like bookkeeping, financial planners, and so on and so forth. So I would say that the existing consulting firm like Chartered Accountant, the Deloitte of this world, they have to adapt, because the software wave, especially for, I would say, the small mission, will take over. That's pretty granted. So it's hard to foresee the future, because we have several thousands of companies in the fintech market. But it's gonna be a super interesting moment. I'm pretty sure about it.
Okay. And you think regulation will be part of it?
Yeah, of course. It has to be.
Okay. Now, that was a very, very interesting conversation. Thank you very much for joining me today.
Thank you for the invitation.
Thank you. It was a pleasure speaking with you. And I wish you the best in your upcoming venture.